I mean, yeah, the U.S. Treasury officially has 8,133 metric tons of gold, and the Federal Reserve has gold certificates that are claimed to that gold. And the reason that happened was back in '33 when Roosevelt, when he took in all the gold, he made gold illegal, and people had to hand in their gold and take Federal Reserve notes for it. All the gold came through the Fed regional banks, and then the Fed regional banks gave the gold to the Treasury, and the Treasury issued these gold certificates, and that was at $20.67. And then in 1934, they came out with the Gold Reserve Act in January 30th, I think, 1934. And that day they revalued gold to $35, and the Fed sent the profit to the Treasury because the gold was taken in at $20.67, and the revaluation, they sent the profit to the account of the Treasury, and they kept those certificates. And then in 1972, after Nixon closed the gold window, the Congress revalued that price from 35 to 38 because, the international price of gold was going up, and it didn't make sense to have the price at 35. They revalued it again in 73 at 42.22. And by then, gold was almost at 100. So they're always late, but they haven't revalued it since then. So all that gold and the certificates at the Federal Reserve are worth about $11 billion. So if they revalued the gold certificates to, let's say, $3,400, that would be about $800 billion in profit for the Treasury, and they would have to write new certificates for the Fed at $3,400, and the Fed would send the profit to the Treasury, and they could use that to do whatever they want to. So if you revalue it to 15,000, I mean, that's a much bigger number. I think Clive came up, I don't know how much it was. So that's about four times. So it's about 4 trillion. If you do it to 30,000, that's 8 trillion. So they could choose any number. But the thing is about revaluing, and we saw the other day, Alexei, that even the Federal Reserve Board now, on August 1st, they published an article about how this process works, and they'd never done that before. So are they preparing to do a revaluation? I don't know. It's just speculation. But if they revalued it to the market price right now, let's say 3,400, yes, they'd have an extra 800 billion, the Treasury. That would help them. But what it would do, it would put a floor under the gold price, because back in 73, when they revalued it to 42.22, we never saw that price again. And by 1980, the price of gold had gone up to like almost 900. So it would be, even if they revalued it to 3,000, for example, it would be very bullish. They might want to do it a little more than the current market price, maybe because they might want more profits for the Treasury. They might just let the market keep going higher, and then maybe in 6 months to a year announce it, let's say at 4,500. Or they could announce it over the weekend at 10,000, and that would basically close down the gold and silver market probably for a week, because things would just go crazy. I don't know what would happen, and that's why I tell people it's better to be early than one day late, and that's why I say, you need a little bit of physical gold and silver. I agree with you. It's difficult to tell what the repercussions would be for the dollar, but it's been done before. I was reading actually the Fed paper that came out recently. Germany did it in '97. Italy did it. One thing is that a lot of countries now, especially China and Russia, they've been buying a lot of gold. They would do very well as well. So would European countries that have a lot of gold. In terms of the debt, if you look at the debt owed to foreigners, treasury debt is about 8 trillion. So that would be how can I say, just over 20%. And even during the 19th century, when there was a gold standard, countries like Britain, they kept like a 33%, 30% gold cover. So yeah, it might not sound that much, 8 trillion out of 37 trillion in debt, but a lot of people argue that the gold cover should be more related to the money supply, i.e. M2, and M2 is around 22 trillion. So 8 trillion wouldn't be that bad. I would say it would be like a 40% cover. And when the Fed was created, or back in the 30s, they used to have a 40% cover. Every Federal Reserve note needed to be 40% backed by gold. So I don't think it would be a problem. And I guess if the U.S. did this every 5-10 years, this revaluation, then yeah, they would lose credibility. But they've waited. You know, if they do it, they would have waited over 50 years. So yeah, and the other thing you might say, why you're valuing your most valuable asset at $42 if it's worth so much more. So yeah, it might affect things a bit, but I actually think it would be bullish for everything, for the economy. It won't solve the problem of debt, because I still think politicians are addicted to it, but it would buy them time.
When people talk about financial markets, the first thing they usually mention is the stock market. Switch on the news, whether it's in London, New York, or Tokyo, and the presenter will tell you the FTSE is up, the Dow is down, or the Nikkei is flat. They might throw in a bit about the pound or the euro, but what they almost never mention is the bond market. And that's remarkable because the bond market is bigger than stocks, bigger than currencies, bigger than just about anything else in finance. It is the backbone of the entire system. Governments issue debt, central banks manage interest rates, institutions park their money in bonds, and the rest of the financial world builds on top of that foundation. Yet most people have no idea how it works. That's by design, because once you start to understand bonds, you realize just how fragile the system really is. Take the US Treasury market. It is supposed to be the safest, most liquid market in the world. That's what textbooks say. But in reality, it's increasingly held together by gimmicks. Janet Yellen was heavily criticized for issuing too much short-term debt when she was Treasury Secretary. But what are they doing now, issuing more short-term debt? Why? Because it puts less pressure on long-term interest rates. If you flood the market with 30-year bonds, yields spike, and the cost of financing the government's deficits explodes. If you issue more 1-year or 2-year bills, you can kick the can down the road. But the problem is those short-term bills mature quickly, and then you need to roll them over again and again, often at higher and higher rates. It's like putting your entire mortgage on a variable rate just as interest rates are rising. You can survive for a while, but eventually it catches up to you. The Treasury has also started talking about buybacks. That means they issue short-term debt, get the cash, and then use it to buy long-term debt in the market. It's another sleight of hand, another way of massaging the yield curve. In effect, they are doing the job the Federal Reserve used to do during QE. But here's the twist. The Fed is no longer buying bonds. In fact, they're letting bonds roll off their balance sheet in what they call quantitative tightening. So the Treasury is stepping in to do its own version of yield curve control. They won't call it that, of course. They'll come up with a technical phrase, bury it in a report, and hope nobody notices. But that's what it is. And the average person on the street will never hear about it because it won't be on the evening news. Meanwhile, the bond market is groaning under the weight of all this debt. Japan is a case study in how long you can play this game. For decades, they kept interest rates at zero, warning of deflation, warning that prices might go down. Imagine that, treating lower prices as a threat, when for ordinary people, lower prices are a blessing. But this was the Keynesian mindset. You must have inflation to keep the system going. And now, even in Japan, the narrative is breaking. Inflation is running higher, savers are frustrated, and the bond market is under strain. Yields are rising, bonds are falling, and the Bank of Japan is losing control. The US will try to repeat the Japanese trick. They'll announce that they won't allow the 10-year yield to rise above a certain level, say 3.5%. If the market tests it, the Fed will step in and buy. That's yield curve control. It's QE with a different hat, but every time they do it, the currency takes another hit. Every time they cap yields, they debase the dollar further, and that shows up in the cost of living. Energy, food, housing, all go up. The average worker feels poorer, even if their paycheck hasn't changed. Now, some people think the solution is to go back to QE proper. Just fire up the printing presses, buy everything in sight, push rates down, and keep the party going. But QE has its own consequences. It inflates asset prices. It makes the rich richer because they own the assets. Stocks, bonds, property, all soar under QE. But wages don't. So the gap between the elite and the average person widens. That's exactly what we've seen over the last 15 years. And the social consequences are enormous. It breeds resentment, populism, political instability.
Bond market is a market that is not followed by the general public. When you listen to the news, financial news or any news, especially, well, at least here in the UK, they say, the stock market did this and the currency did this, but they never talk about bond yields or anything. So, and what the Treasury is doing is something very technical. So that won't even see the light of day in the mainstream news for the general public. So what they're doing is they are issuing more short-term debt so that there's not that much pressure on the longer-term interest rates. So they're doing actually what Janet Yellen was doing, and they were critical of Janet Yellen. The other thing they're doing, I saw that they can buy back like existing debt, long-term debt. When they issue short-term debt and they get the cash, they can go in and buy 5 and 10 years debt. And I think they're doing that. Actually, they announced it a couple of weeks ago, the Treasury. So that's how they do it, because right now the Federal Reserve is still doing quantitative tightening. They're still selling their treasuries or letting them roll off without adding them back on. So yeah, they can do it, and they can kind of do a yield curve control, which is usually something the central bank does. So the other thing with a possible revaluation, let's say if they revalue to a level where they got, let's say, around 6 trillion or maybe a little less, they could actually go to the Federal Reserve and buy almost all their assets, because the Fed's balance sheet is like just under 7 trillion, that they could go and buy 6 trillion worth of it and retire all that debt, treasury debt and mortgage debt. And then the Fed's balance sheet would go back down to like 800 billion, which was where it was before the '08 crisis, and then they can start inflating the credit system again. Maybe that will happen once we get that 1-to-1 Dow gold ratio. That would make sense, because from then they can start again. It's going to be another 30, 40 years maybe of boom. But before that, it's going to be painful, and it's already painful, I think, for the majority of people. It's only the people at the top and the very wealthy that are benefiting right now, because asset prices are going up and they have a lot of assets.
So how would it actually differ from this yield curve control compared to the QE playbook? And why might it actually be harder to unwind this time?
Yeah, a QE is just the central bank going into the secondary government bond market and buying bonds. They don't go straight to the auction when the Treasury sell bonds, because it would look too Weimarish. I mean, buying debt directly from the Treasury. So they allow the primary dealers, mainly the Wall Street banks, to buy at the auction, and they go in and buy the bonds. yield curve control is more of not a threat, but an announcement to the markets that, for example, the Fed will not allow the 10-year yield to go above 4.5%.
So where does this all go from here? Well, if you listen to the mainstream commentators, they'll tell you not to worry. They'll say the Federal Reserve has everything under control, that inflation is transitory, that deficits don't matter, and that markets always go up over time. But these are the same people who told you in 2007 that the subprime crisis was contained. The same people who said in 2020 that printing trillions out of thin air would have no consequences. You can't take them seriously. The reality is that the system is cornered. The U.S. has $37 trillion in federal debt, plus trillions more in unfunded liabilities. The interest bill alone is approaching $1 trillion a year. That's more than defense spending, more than Medicare, more than almost anything else. And the only way to keep the game going is to issue more debt. But who's buying it? The Chinese aren't. The Japanese aren't. The Saudis aren't. In fact, most of America's traditional creditors are net sellers. So the Treasury is left playing shell games with short-term bills, buybacks, and maybe, just maybe, preparing for a gold revaluation. Now let's imagine they actually go through with it. Suppose they announce on a Sunday evening that gold is now officially $10,000 an ounce, and the Fed's gold certificates will be marked to market. Suddenly, the Treasury has trillions in profit to play with. The debt-to-GDP ratio looks less catastrophic. The bond market breathes a sigh of relief, and the politicians pat themselves on the back for being prudent stewards of the nation's finances. It would be the ultimate accounting gimmick, but it wouldn't be without consequences. The dollar would collapse in purchasing power. Imports would become far more expensive. Inflation would rip through the system, and yet for manufacturers, for exporters, for people making tangible things in America again, it would be a blessing. Trump has already made it clear that he wants a weaker dollar, he wants tariffs, he wants reshoring, he wants to bring back the factories. A revaluation fits that narrative perfectly. This is where it gets really interesting, because while the US might try to play catch-up with gold revaluation, the BRICS are already building an alternative system. China's M-Bridge platform is operational. It's settling transactions in seconds. It's tied into ASEAN, the Middle East, and Africa. It's backed by gold vaults in Shanghai, Hong Kong, Dubai, Moscow, and soon Riyadh. And it's explicitly designed to bypass SWIFT and the dollar. Sergei Lavrov said it himself. This system is faster, cheaper, and immune to Western sanctions. That's not a conspiracy theory. That's their stated policy. So the world is bifurcating. On one side, you have the dollar, the euro, the pound, the legacy fiat currencies, backed by nothing but trust, and that trust is eroding fast. On the other side, you have a new architecture, with gold quietly reintroduced as the settlement asset of last resort. The irony is that the West spent decades mocking gold as a barbarous relic, and now the countries that actually make things, the countries with trade surpluses, with manufacturing capacity, with natural resources, are using that relic to build the future. What does that mean for the average saver, the average investor? It means you can't just sit in cash and assume it's safe. Cash is a melting ice cube. It looks solid until you realize the freezer is broken and it's dripping all over the floor. If you hold your wealth in dollars or pounds or euros, you're on the wrong side of history. Now people often ask me, Mario, do you really think they'll confiscate gold again, like Roosevelt did in 1933? And my answer is, I wouldn't rule it out. Politicians are not guided by common sense. They're guided by desperation and the pressure of the mob. If gold is revalued and ordinary people who had the foresight to own it suddenly look like geniuses, don't be surprised if there are calls to tax windfall profits or even restrict private ownership. But here's the catch. In 1933, gold was mostly held in banks, in safety deposit boxes, in plain sight. Today, people can hold it privately, discreetly, even outside the banking system. And global capital flows much faster. Try banning something in the age of Bitcoin and encrypted messaging and see how far you get. If anything, a ban would just send the black market price soaring even higher. This is why I say, better to have it now, quietly, than to scramble later when the politicians change the rules. Let's pivot back to bonds for a moment, because this is crucial. The bond market is the dog that wags the tail. Stock markets get all the headlines, but bonds are where the real money is. When yields rise, everything else breaks. Mortgages, corporate debt, derivatives, they all hinge on low yields. And right now, yields are creeping higher, despite all the tricks from the Treasury. Japan is the canary in the coal mine. They've had zero rates for decades, but now inflation is biting, savers are angry, and the bond market is wobbling. If Japan can't keep the game going, what chance does the US have with 10 times the debt? The answer is not much. That's why I believe yield curve control is inevitable. The Fed won't call it that. They'll just quietly announce that they won't let the 10-year go above, say, 3.5%. And if the market tests that level, they'll start buying bonds hand over fist. It's QE by another name. But every time they do it, the dollar gets weaker, commodities get stronger, and gold gets a bid. It's a vicious cycle, and the only way out is either default or revaluation. Now, people sometimes say, Mario, you're too pessimistic. Governments always find a way. They'll muddle through. And yes, they do muddle through, until they don't. Rome muddled through for centuries, debasing its currency with more and more copper until the denarius was a joke. Britain muddled through with the pound until 1944, when Bretton Woods crowned the dollar king. Muddling through is just the polite way of saying slow collapse. The question is, do you want your wealth tied to a system that is slowly collapsing, or do you want it anchored to something real? And let's not forget the social dimension. Inflation isn't just a number on a chart. It's the cost of living. It's the mother in London who can't afford heating. It's the pensioner in Ohio who can't pay for groceries. It's the young couple in Madrid who will never own a home because mortgages are unaffordable. Inflation is theft. It transfers wealth from savers to debtors, from the poor to the rich, from the periphery to the center. That's why governments tolerate it. But eventually people notice. And when they notice, politics shifts. That's when populists rise. That's when social unrest erupts. That's when faith in institutions collapses. Gold doesn't solve all of that, but it provides a personal escape hatch. It's the lifeboat when the ship hits the iceberg. So what's the playbook from here? In my view, it's pretty straightforward. First, expect more short-term gimmicks, stable coins tied to treasuries, buybacks of long-term bonds, jawboning about temporary inflation. Second, expect some kind of revaluation event, maybe sudden, maybe gradual, that brings gold back into the monetary equation. Third, expect the BRICS to keep expanding their network, bringing more countries into their orbit, offering them a real alternative to SWIFT and the dollar. Fourth, expect ordinary people in the West to be the last to know, the last to act, and therefore the ones most blindsided when the reset hits. That's why I keep hammering this point. Don't wait for the headlines. By the time you read in the Financial Times that gold has been revalued or that BRICS has launched its settlement currency, the window of opportunity will be gone. You prepare now, quietly, patiently, little by little, and then, all at once, the world changes. So to wrap this up, here's my core message. The fiat system is dying. The signs are everywhere. Record debt, rising yields, collapsing trust, new payment systems outside the dollar. The elites know it, which is why they're quietly reshoring gold, publishing papers on revaluation, and experimenting with stablecoins. The BRICS know it, which is why they're building the infrastructure for a gold-linked world. The only people who don't seem to know it are the average savers in the West, who still think their pensions and their cash deposits are safe. Don't be one of them. Don't be the person who wakes up one Monday to find that gold is $10,000, the dollar is down 50%, and you're left holding the bag. Be early, be prepared. Hold some physical gold and silver outside the system. Because when the reset comes, there will be no press release inviting you to participate. It will just happen, little by little, and then all at once.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.